Imagine you graduate college. You study something practical. You got decent grades. You applied early. You got a job. It pays $62,000 a year. You show up on time. You work the extra hours. You skip the expensive vacations. You meal prep on Sundays. You read the personal finance forums. You open a 401k. You set up automatic contributions. You are by every measurable standard doing the responsible thing. 2 years in, you have about $4,000 saved. Rent 60% of your take-home pay. Your student loan minimum payment is $340 a month. You needed a car. Car insurance for someone under 25 is basically a second rent. You got a small raise, 3%. Inflation was higher. You got poorer while receiving a raise. And your co-worker who's 49 just sold a house for a gain of $280,000 in 4 years without doing anything except owning it. Here's the question. What exactly did you do wrong? The honest answer is probably nothing. And that's the problem. This video is about why that answer is true, why it's getting more true every year, and what it actually means mechanically for anyone who wants to build wealth in 2026 without lying to themselves about how the system works. We're going to explain how the wealth-building machine operates right now, why it used to reward effort, and why it increasingly doesn't. We're going to do it by looking at incentives and structure, not individuals, and blame. Let me introduce the idea we're going to use for the whole video. Think of the economy as a conveyor belt. You step on it. You walk forward. In a healthy system, if you walk faster, you get ahead. For most of the 20th century, that's more or less how it worked. Walk hard enough, save enough, eventually you accumulate something real. Effort was the primary input. Ownership of assets was something you built towards slowly, incrementally, from the proceeds of your labor. What happened is the belt started moving backward. And it's been speeding up roughly since the early 2000s, dramatically since 2008, and almost vertically since 2020. And here's the part nobody says clearly, it's not moving backward equally for everyone. If you already own things, stocks, real estate, a business, the belt moving backward actually pushes you forward because the belt is inflation, the belt is asset appreciation, the belt is the widening gap between what things cost and what labor earns. If you own assets, the belt is your ally. If all you have is earned income, the belt is your opponent. And Gen Z, the first generation to enter adulthood after all of this fully crystallized, stepped onto a belt moving backward at roughly 6% a year with nothing to hold onto yet. For cycles, each one feels a little darker and a little more precise. Let's go. The first thing I want to dismantle is something that sounds almost offensive to say out loud, but it's the foundational misunderstanding that everything else sits on top of. Working hard is not a wealth-building strategy. I know how that reads. Stick with me for 2 minutes because this isn't a nihilistic or lazy take, it's a mechanical one. And the distinction matters enormously. Work is a transaction, you sell time and skill, someone buys it. The price they pay is called your salary, and in that transaction, the buyer, your employer, is trying to pay as little as possible for as much output as possible. That's not malicious, that's just what every rational buyer does in any market. You try to buy things at a discount. So, your employer is not trying to make you rich. Your employer is trying to extract value from you at a margin. The system is designed so that you produce more value than you receive. The difference is called profit, and profit flows to whoever owns the entity, the shareholders, the founders, the asset holders. This has always been true to some degree. The difference now is the ratio, and the ratio has become extreme. In 1975, American worker productivity and wages grew roughly in parallel, not perfectly, but close enough that effort over time reflected in compensation with some reasonable fidelity. You worked harder, you got promoted, you got raises, the gains were somewhat shared. The belt was slow or moving forward. Now look at the last 40 years. Worker productivity in America has increased by roughly 60% since the early 1980s. Real wages for the median worker, adjusted for inflation, have increased by somewhere around 15% over the same period. 60% more productive, 15% more pay. The other 45% went somewhere. It went to shareholders, it went to asset holders. It went to the people already on the right side of the belt. Gen Z didn't cause this. Gen Z just arrived when the gap was at its widest point in 100 years. And it creates this deeply counterintuitive situation. You can be genuinely hardworking, genuinely skilled, show up every day, perform well, advance your career, and still not build meaningful wealth, because the system's reward for effort has been structurally redirected toward ownership. Not overnight, not dramatically, just quietly year by year for 40 years, until you look up and the math simply doesn't add up the way the old story said it would. This is what I call the effort illusion. The belief that if you just try harder, produce more, hustle more, stay disciplined long enough, eventually the numbers will work. They won't. Not because you're bad at working, because you're playing a game that has been gradually replaced by a different game, and nobody handed you the updated rulebook. Here's a simple way to see it. Let's say you earn $65,000 a year. After taxes and non-negotiable expenses, rent, food, transportation, phone, health insurance, you're saving maybe $500 to $800 a month. If you're genuinely disciplined, call it $600. In 1 year, you've saved $7,200. That's not nothing. You feel the progress. You're doing the thing. Meanwhile, someone who bought a house 5 years ago for $350,000 is now sitting on a property worth roughly $490,000. They gained $140,000. They didn't work for it. They didn't wake up earlier. They didn't learn a new skill. They just owned something and the belt did the rest. You would need nearly 20 years of disciplined saving to equal what they made passively in 5. And here's the thing, the homeowner isn't evil. They didn't do anything wrong. They just got in earlier on the right side of the belt. The system is rewarding them for owning. It is not rewarding you proportionally for working. Now, someone will say, well, just buy something then. Problem solved. And I want to address that because it's the exact thing people have been saying for 30 years without actually doing the math on what entry costs look like right now. Because that brings us to the second layer. And the second layer is about the actual cost structure Gen Z is operating inside. This is where the public conversation is, I think, the most dishonest, or maybe not dishonest, just lazy. People compare difficulty across generations without measuring the right variables. The question isn't whether previous generations had it hard. The question is, what did sustained effort actually purchase in proportional terms? In 1976, when the oldest boomers were turning 30, the average American home cost about $42,800. Adjusted for inflation, that's roughly $242,000 in today's money. The average home at the end of 2025 was $405,300, about 1.5 times more expensive even after adjusting for inflation. But price alone isn't the whole picture. The ratio of home price to income is what actually matters for accessibility, and that ratio has collapsed. Over the last 6 years, the income required to afford a medium-priced home in the United States jumped 70% from about $67,000 in 2019 to $114,000 in 2025. The median household income did not jump 70% in that time. It went up maybe 15 to 18%. So, in 6 years, the entry threshold for homeownership moved about $40,000 per year to the right, with no corresponding improvement in the quality of the houses. The same houses, just dramatically less reachable, and it gets worse when you add what I'd call the debt layer. College tuition has increased more than 300% since the 1980s, and student loans now total more than $1.83 trillion nationwide. Younger generations carry the bulk of this burden, which reduces their ability to save, invest, or qualify for mortgages. So, the typical Gen Z person entering the workforce is doing so while carrying student loan debt, competing in a housing market that requires an income well above the median, paying rent that in many cities eats more than 30% of take-home pay, and experiencing a post-pandemic cost of living reality that most economic commentary has been too slow to internalize. Since 2019, cumulative inflation has climbed to 26%, meaning you need $126 today to buy what $100 bought pre-pandemic. That's not ancient history. That's the last 6 years of your working life. Every dollar you've earned has 26% less purchasing power than when the decade started. And if you're in the bottom 60% of earners, which most young people are because entry-level pay is entry-level pay, your personal inflation rate is even higher because you spend a larger percentage of your income on housing, food, and transportation. Those are the exact categories that inflated the most. The report attributes much of the strain to rising living costs that have outpaced wage growth for many households. That's polite language for you are objectively losing ground every month, and the nominal numbers in your bank account may not reflect it yet. But here's the part one actually find most interesting from a systems perspective, because it's not just about things being expensive, it's about which things got expensive and which didn't. The cost of a flat-screen television dropped about 90% in real terms since 1994. Streaming entertainment is practically free at scale. Fast food is still relatively cheap per calorie. Flights got cheaper for a long time. Consumer electronics improve every year at lower prices. So, day-to-day hedonic consumption, the stuff that makes life feel comfortable and enjoyable in the short term, has been made artificially affordable. But housing, healthcare, education, and child care have all exploded. These are the inputs to long-term financial stability. These are the things you actually need to have a stable adult life that compounds on itself over time. These are the on-ramps to wealth. The belt is designed, whether intentionally or not, to keep you comfortable enough not to revolt, but not stable enough to actually accumulate. You can afford cheap entertainment. You cannot afford affordable real estate. Rising economic pressures are shifting financial behavior from long-term planning to daily decision-making. 71% of Gen Z and millennials say a side hustle or additional income is required just to keep up. Nearly 80% report using survival spending tactics, and nearly 1 in 3 describe themselves as barely surviving financially. That last stat is worth sitting with. Not barely surviving dramatically, barely surviving quietly while maintaining a professional appearance and a LinkedIn page and an Instagram that makes it look fine. Nearly 49% of US residents report struggling to afford regular rent or mortgage payments. The burden is uneven. About 67% of Gen Z adults say they struggle to cover housing costs. 2/3, not the bottom quartile, 2/3 of the generation. Now, let me make this concrete. Let me show you exactly where the gap opens with real numbers, because the abstract description of a structural problem is a lot less useful than seeing the math play out. 2 people, same age, 24, same starting salary, $58,000 a year in a mid-sized American city, same general discipline, both open investment accounts, both contribute to their 401ks, both are doing the things you're supposed to do. The only difference, person A's parents have some savings. They give their kid $40,000 toward a down payment on a first home. Person B's parents rented their entire lives and have no savings to transfer. Person A buys a $280,000 house in 2022. They put $40,000 down and finance $240,000 at a 4.5% fixed rate. Their monthly payment, mortgage, taxes, insurance runs about $1,650. They move in. Person B keeps renting. Rent starts at $1,400 a month and increases about 5% per year, which is conservative. Fast forward to 2032, 10 years later, Person A's house is worth approximately $412,000 based on reasonable appreciation for that type of market. They've paid down about $32,000 of principal. Net equity, roughly $204,000. They also invested $500 a month in index funds throughout, about $90,000 at average market returns. Total net worth from those 2 vehicles alone, approximately $294,000. Person B, same 10-year period, still renting. Rent is now $1,800 a month. Over the decade, they've paid an estimated $192,000 in rent. Gone, no equity, no compounding, just gone. They also invested $500 a month, the same as Person A, so they also have roughly $90,000. Total net worth about $90,000. Same income, same behavior, same discipline. A gap of over $200,000, and the only variable was the $40,000 gift at the start. That $40,000 became a $200,000 difference over a decade, not because person A is smarter or more disciplined, but because they got onto the ownership side of the belt earlier, and the belt did the compounding for them. Now, someone will say, well, person B saved for the down payment themselves. Right. Except, over the past decade, urban rents have climbed about 4% per year, while wages for full-time workers have increased by only 0.6% annually. After taxes and non-negotiable expenses on a $58,000 salary, maybe $400 remains per month. Saving $40,000 at $400 a month takes 8 years and 4 months. The median house price has risen about 90% in just 10 years, or more than 6% each year. By the time you save $40,000, the house that was $280,000 is now $380,000. You need a bigger down payment. The goalpost moved. The belt moved. This is not a discipline problem. This is a physics problem. The math doesn't close. And the people telling you to just save harder are often the exact people who received an equivalent of person A's $40,000 head start in one form or another, and simply forgot about it. If you're watching this, and the explanation is clicking for you, subscribe. I make videos specifically for people who want to understand how these systems actually work, not get pumped up about them. No hype, just mechanics. Alright, let's go deeper, because everything I've explained so far is mostly about housing and costs, and those are important, but the real structural shift, the one that fully explains why effort increasingly doesn't produce wealth the way it used to, is bigger than housing prices. It's about what kind of economy we've built, and which kind of inputs it rewards. Here's a framework. 2 eras. Era 1, the earnings era, roughly 1940 through the late 1980s. In this era, wealth was primarily accumulated through earning, saving, and gradual asset acquisition. High income meant you could save at a rate that outpaced average asset price growth. The game was earn more, spend less, invest the difference. Effort and discipline were the primary variables. Middle-class wealth was largely earned income converted into assets over time. Era 2, the asset era. From the early 1990s forward, accelerating significantly after 2008. In this era, wealth is primarily accumulated through asset ownership and price appreciation. If you already own stocks, real estate, or a business, those assets appreciate faster than any reasonable savings rate. The game shifted from earn and save to own and hold. Here is the critical difference between these two eras. In the earnings era, the on-ramp was accessible. You didn't need to already be wealthy to start getting wealthier. Houses weren't that expensive relative to salaries. Entry costs were low enough that disciplined effort could get you there within a reasonable time frame. The system rewarded patience and consistency because asset prices moved slowly relative to wages. In the asset era, you need to already own assets to benefit from asset appreciation. The on-ramp has gotten dramatically steeper. And if you don't own assets, your labor income has to compete against people whose money is making money while they sleep. That's not a race you win through effort alone, no matter how much you optimize. Instead of the 1990s middle-heavy distribution, when working-age households held almost 70% of all wealth, 2025's distribution places about 65% of all wealth in households over the age of 60. This shift suggests that wealth has moved from an earnings-based model toward an investment-based model. Today, wealth is concentrated among households with the most time for asset growth and returns. The greatest value currently comes from owning previously purchased assets. That's the sentence. Baby boomers and many older Gen Xers got to do both things. They accumulated assets during the earnings era when it was possible to buy a house on a single income and then held those assets through the asset era, watching them multiply. They got the compounding benefit of both systems simultaneously. They earned their way in when entry costs were low, then got paid to wait while the belt worked in their direction. Boomers benefited from a fourfold surge in financial markets during their 30s, accelerating their wealth growth. Their prime earning years coincided with one of the greatest bull markets in history. The system rewarded them for showing up at the right time. Gen Z arrived just as the transition to the asset era was complete. They stepped onto the belt after it already reached full speed in the wrong direction. Baby boomers hold the largest share at 51% of U.S. wealth, collectively valued at $90 trillion as of late 2025. The remaining wealth belongs to millennials and the oldest members of Gen Z. Older Americans are currently wealthier than ever, with the average 50-something holding $1.4 million and the average 60-something worth $1.60 million. In contrast, the average 20-something has a net worth of $139,000. That's an 11-to-1 ratio between someone in their 60s and someone in their 20s. In earlier decades, that ratio was closer to 3 or 4 to 1. The gap has roughly tripled, and it's not explained by normal age-based wealth accumulation. It's explained by the fact that asset appreciation has been compounding for decades in the hands of people who got in early, and the people who arrived late are working against the structurally different set of math. Here's what I think most people miss about this. This isn't just an inequality story, it's an incentive story, and that distinction is important. When most of the generation's wealth is in asset appreciation, rather than earned income, the political incentives of that generation change. People who own assets vote for policies that protect asset prices. Housing supply has been low since the 2008 recession, exacerbated by sky-high mortgage rates, which disincentivized home sales and contributed to exorbitant home prices. That supply shortage didn't happen by accident. It happened in a political environment where existing homeowners consistently opposed new construction in their neighborhoods, because new supply would moderate prices and reduce their equity. They're not villains, they're rational. Their net worth is tied to that house appreciating. The system aligns their incentives against yours. They oppose wealth taxes, they support low capital gains rates, they have more political power, more time to participate in local governance, more lobbying resources, and their financial interests structurally conflict with the financial interests of anyone who doesn't already own significant assets. Again, not a conspiracy, just incentives. The belt runs in the direction that the people operating it benefit from. And those people are disproportionately not Gen Z. Now, you might be thinking, okay, but the great wealth transfer is coming. Boomers have all this money, they have to pass it somewhere. Won't that fix things for Gen Z? I want to stress test this, because it's technically true in aggregate and almost completely misleading in practice. And this is the fourth layer, and it's the one that I think most people don't want to look at directly. About $84 trillion is anticipated to pass down from seniors and baby boomers to Gen X, millennials, and Gen Z by 2045. That number gets cited constantly as a source of hope, and it is a real number. But let's ask the honest question, which Gen Z people actually receive it? Families with significant assets tend to pass them to children who already have some financial footing. For younger Americans whose parents didn't accumulate much, the transfer won't change their situation. Inheritance is more likely to widen the gap within younger generations than to close the one between them and their parents. That's the sentence that reframes the entire great wealth transfer narrative. It doesn't close the generational gap, it accelerates the gap within the generation. Think of it this way, the wealth transfer is not a rain shower, it's a targeted irrigation system. It waters the places that are already greenest. If your parents bought a house in a major metro area in 1992 for $120,000 and that house is now worth $700,000, you could inherit something transformative. A down payment, maybe the house itself. Capital that can be deployed immediately to get onto the ownership side of the belt. A head start that compounds for decades. If your parents rented their entire working lives, which to be clear is not a moral failure, it's what happens when you step onto the belt at the wrong time with insufficient initial capital, then the great wealth transfer is largely not for you. Heirs who do receive assets benefit from built-in tax advantages. Under current law, inherited securities and real estate get a stepped-up cost basis, resetting the taxable gain to the asset's value at the time of death. A home bought for $120,000 in 1985 and worth $650,000 today can be sold by the heir measured only from that higher figure. This allows for the repositioning of inherited wealth at much lower tax cost than if the heir had bought the asset themselves. So, not only does the inheritance go primarily to people who are already advantaged, the inheritance itself comes with tax architecture that further advantages people who inherit over people who earn. The system structurally prefers inherited capital over earned capital from a tax efficiency standpoint. That's not a conspiracy theory. That's the actual legal structure. Most of the wealth transfer money will be handed over to Gen Z, 10th and millennials, but 38% of Gen Z still anticipate they will receive an inheritance. 38% meaning 62% of Gen Z is not expecting to receive anything meaningful. And for the 38% who are expecting something, the timing, the amount, and the tax treatment will vary enormously. This is not a generation-wide tailwind. It's a narrow pipe delivering water to the people who are already less thirsty. And what this creates, and this is what I find genuinely new about the current situation, is a massive divergence within Gen Z that looks invisible from the outside. There are effectively two Gen Z tracks running simultaneously. Track 1, parents-owned assets. Some capital is available or will become available. Educational debt is manageable. First job led to a career path within a reasonable time frame. Maybe rent was covered for a period. Maybe a down payment was gifted. Maybe a loan was backstopped. These people got onto the ownership side of the bell earlier than average, and the compounding is working for them. They're building wealth at relatively normal pace. They feel like the system is hard but navigable. Track 2, parents rented or built little equity. Student debt is significant. The white-collar job market for new graduates has been genuinely brutal. Gen Zs are described as overeducated and underemployed, with new entrant unemployment up over 9% year-over-year in recent data. Every dollar earned goes directly towards survival costs. Nothing is left over to deploy. The belt is moving backward faster than any conceivable savings rate. These people are doing everything the system said to do and falling behind anyway. Not by a little, by a compounding lot. Both of these people could have the same resume, same degree, same LinkedIn, same work ethic. The difference is entirely upstream. It's about what belt they started on, not how hard they walk. The economy is no longer moving as a single system. It's splitting into a K-shape. What looks like resilience at the top increasingly masks fragility underneath. And within Gen Z, you're seeing the same K-shape play out at a generational level. One group is getting traction, one group is running in place, and the gap between them is going to compound for the next 30 years. Quick pause. You know what I love? Financial influencers who respond to everything I just described with, the real problem is your mindset. Like, yes, housing costs require $114,000 income, cumulative inflation is 26% and the average 20-something has a $139,000 net worth. But, bro, have you tried journaling? Have you considered that your limiting beliefs are the actual mortgage rate? Also, imagine explaining the housing situation to a 57-year-old. Back in my day, we just made sacrifices. I'm making sacrifices. I haven't been on vacation in 3 years. Well, cut back on subscriptions. I cancelled everything. I have one streaming service. What about coffee? I make it at home. I don't know, kids today just don't want to work for it. Okay, so we've established the problem, and I want to be clear about what the problem actually is because this is the reversal that the whole video has been building to. You think the problem is that Gen Z doesn't work hard enough, doesn't budget correctly, doesn't sacrifice enough. That's what the public conversation implies. That's the dominant narrative from people old enough to have benefited from the earnings era. But, actually, the problem is structural. The problem is that the wealth-building game changed its rules mid-run from an effort-rewarding system to an ownership-rewarding system, and the on-ramp to ownership has become inaccessible to anyone who didn't start with or inherit initial capital. Working harder on a backward-moving belt doesn't move you forward. It just delays how far back you end up. Young Americans increasingly feel the financial system is stacked against them, with 7 in 10 Gen Z and millennial adults saying wealth is out of reach as survival spending becomes the norm. And here's what's important about that statistic. It's not pessimism. It's not weakness. It's a rational assessment of the math. These people have looked at the numbers and correctly identified that the old playbook doesn't produce the old results. The problem is that most of them haven't been handed a new playbook. That's what the rest of this video is. Because understanding the problem is not the same as being trapped by it. If the machine is designed a certain way, you don't fix your situation by working harder inside the machine. You understand how the machine works and you find the leverage points that exist right now in this specific version of the economy, not the economy of 20 years ago, this one. There are 3 shifts that separate the people in Gen Z who are quietly building real wealth from the ones who are quietly falling behind. And I want to be specific about these because the generic advice you hear, invest more, budget better, add income streams, is not wrong, it's just incomplete. It doesn't account for the structural context. These 3 shifts do. Shift 1. Stop treating income as the destination. Treat it as the fuel. This is the most important reframe. Income is not wealth. Income is the raw material that can be converted into wealth, or it can be converted into consumption and disappear. The entire financial media complex is built around helping you maximize income, as if clearing $100,000 a year automatically puts you on the path to something. It doesn't. Because if your cost structure expands to match your income, which it almost always will if you're not deliberately resistant to it, you've just moved to a more expensive version of the same backward belt. In an increasingly digital economy where financial stability seems out of reach, young people turn to less traditional and riskier forms of investing rather than contributing to a 401k. A Gen Z person might trade stocks for a platform like Robinhood. Those platforms make investing more accessible, but their primary goal is to keep users on the platform rather than help them build wealth. That's the trap. High-frequency gamified investing feels like doing something. It scratches the productivity edge, but it's optimizing for the wrong variable. The more they trade, the more the company benefits. And there's overwhelming evidence that active traders tend to make less of a return than more passive investors. The people I've observed build real wealth quietly in their 20s are almost never the highest earners and almost never the most active traders. They're the people who systematically optimize the gap between income and expenses and deploy that gap into ownership as aggressively as possible, even imperfect ownership, even small positions, even a house in a second tier that nobody on social media is celebrating. Anything that moves them from being purely a labor input to being in some partial way an owner. The question to ask yourself every single month is not how much did I earn, it's how much of what I earned did I convert into something that compounds. Shift 2. Understand leverage before you think you need it. Leverage is why the gap between person A and person B in our case study was over $200,000 from a $40,000 head start. Leverage is the principle that a small amount of capital deployed correctly with sufficient time produces a disproportionately large result. A mortgage is leverage. An index fund is passive leverage. You're using a small contribution to hold a fractional stake in hundreds of enormous businesses that are working on your behalf around the clock. Starting any kind of cash-generating digital side income is leverage. You're using a small amount of initial effort to create a recurring return that doesn't require your time proportionally. The mistake most people make is waiting until they fully understand leverage before using it. By the time you feel confident enough to deploy capital, 3 years have passed, valuations have moved, and the entry point you were staring at is gone. You don't fully understand leverage by studying it indefinitely. You understand it by using it carefully early on small scales where failure is instructive rather than catastrophic. And specifically for Gen Z, in a world where entry-level salaries are being compressed by a difficult white-collar job market and a cost structure that's genuinely brutal, your most valuable form of leverage right now is time, not money. Time. Gen Z may be following baby boomers' lead in stock market investments, which is actually the right instinct, but the critical variable is starting now, not later, not when you earn more, not when you feel ready. The compounding math is almost offensively favorable for someone in their early 20s who starts putting anything into the market consistently compared to someone who waits until their mid-30s when they feel financially comfortable. A $200 monthly investment at 22 years old is worth more at 50 than a $2,000 monthly investment started at 35. The difference isn't discipline, it's time and compound interest. The belt can work for you, too, if you get on the right side of it early enough. Shift-free proximity to capital is almost as good as capital if you have the right skills. I talked at length about how the great wealth transfer is going to benefit some people within Gen Z enormously and do almost nothing for the other 60%. That's true, but there's a third path, one that doesn't require inheritance, doesn't require rich parents, and doesn't require getting lucky in crypto at 21. Wealth and assets were once concentrated among households with the highest income. Today, wealth is concentrated among households with the most time for asset growth and returns. That means the people with the most capital are disproportionately people in their 50s and 60s who are time poor, digitally under-equipped, and increasingly dependent on younger people to maintain and grow what they've built. There are small business owners right now in their late 50s with no succession plan. There are real estate investors who want to exit but don't know how to navigate the current market digitally. There are entire industries where enormous amounts of capital are sitting in analog operations that need digital infrastructure. The gap between where capital is and where digital competency is, that gap is a leverage point. Proximity to capital is almost as good as capital if you understand what capital needs. Not in a network your way to success way, that's a vibe, not a strategy, in a specific mechanical way. Certain industries and roles put you adjacent to capital allocation decisions. Certain skills are things that wealthy asset owners will pay for repeatedly and at high margins because the alternative is letting their assets stagnate. Understanding what those are in your specific context and positioning yourself there deliberately is a genuine lever. Half of Gen Z say they aspire to start their own business according to McKinsey. That entrepreneurial instinct is not naive, it's structurally correct because businesses, even small ones, are one of the few remaining mechanisms through which someone without inherited capital can build ownership quickly. But the point isn't to start a business because it sounds cool. The point is that ownership of anything that generates returns without requiring your linear time is the thing the system rewards, and a business is a form of that. The belt doesn't care how hard you walk on it. But if you understand what the belt actually is, the compounding gap between those who own assets and those who only sell labor, then you understand exactly what you need to do to use the belt instead of fighting it. Let's come back to where we started. You graduated. You did everything right. You got the job. You budgeted. You opened the 401k. You meal prepped. You did the responsible adult things that every article told you to do, and you're still barely moving forward while someone 20 years older with a house they bought in a different era keeps accumulating without trying. You didn't do anything wrong, but you were handed a playbook written for a game that already changed. The game is now about getting onto the ownership side of the belt as fast as possible with whatever you have, not perfectly, not when you're ready, now. Because the longer you stay purely on the labor side, the wider the gap becomes. Not because you're failing, but because the asset appreciation on the other side is compounding daily whether you're participating or not. 3 things that actually move the needle. Convert income into ownership, even small amounts, even imperfect assets, as early as possible and as consistently as possible. Use time as your first form of leverage before you have capital leverage because it's the one asset a 20-year-old genuinely has more of than a 50-year-old, and position yourself adjacent to where capital flows, not adjacent to where a hustle is celebrated. Financial conditions have changed faster than the rules. That's the actual situation. The rules you inherited from your parents, from school, from the internet were written for a system that no longer operates this way. Understanding that isn't pessimism, it's orientation, and orientation is the first thing you need before any other move makes sense. The belt is moving. You know which direction now. Subscribe. I explain systems. That's it.